Let's start, if we may, with gas prices and why we're still seeing a big gap between US gas price movement and Europe and Asia. Obviously, there's always a difference between them, but recent events and seeing some LNG shipped from the US to Europe, why hasn't that gap closed more? Why hasn't Henry Hub performed better?
Well, remember, the U.S. only has so much capacity to export gas internationally, about 11 billion cubic feet per day. And that capacity is topped out, which means that the only place that U.S. gas can go at this point is the U.S. or maybe Mexico. So there is a bottleneck there. We can't keep pushing more gas than we are. And the Europeans still have very low inventories. The Europeans have a major gas issue. Now protests are breaking out in Kazakhstan beyond what we've seen already, the tensions we've seen between Russia and the Ukraine. So clearly, European gas traders are concerned about pipeline supplies of gas. And to your point, the big spike that we saw last week attracted some LNG inflows into the region, but still not enough. I mean, Europe is in a very difficult spot. Domestic supplies have really gone down quite a bit, and it's a combination of factors. Really, it's Europe came out of winter with low inventories to begin with. They've underinvested in domestic gas supply infrastructure, and become very reliant on Russia and global liquid gas, which has been going to China for quite some time until the last couple of weeks.
What about the outlook for coal prices, which have responded of late?
Right, so coal should respond a little more. Again, depends where you're looking at, U.S. coal, global coal. But I think on the coal side, the key element that has changed the market around has been the fact that China reopened its domestic coal industry after seeing prices spiking dramatically earlier or later last year. So between October and November, we saw a big spike in gas. In the midst of the COP26 summit, the Chinese government relaxed coal production, domestic coal production, which is ultimately what helped bring prices down. So, we're not as bullish on coal. We think this commodity eventually is going to level off. But on the global gas, there's just not enough gas. So there's a bit of a different gap between coal and gas here at this stage. We're more constructive on the gas. We see higher prices for longer. Coal, we think that is going to eventually start rolling back.
Francisco, besides oil and gas, is the other commodity complex, the broader commodity complex, giving you a sign that inflation has peaked? How do you read some of the rollover we've seen in prices?
Hey, Sarah, thank you for the question. I tell you, I think that we still have a lot of upside across the energy complex. We are going to see oil prices rising a lot further here. We have $85 a barrel on Brent, $82 a barrel on WTI. Current calendar prices for both Brent and WTI are $6-7 lower than that on average. Prices could spike into triple-digit territory by the summer. And, we still think oil is going to keep driving inflation higher for the commodity complex. Now, the Fed is going to tighten, but higher interest rates do not negatively impact commodity prices, at least in the first year. So we are likely to see further pressures across the board on commodities to the upside, led by oil, led by a recovery in transportation. Remember, we have the Omicron spread right in front of us, and yet Brent's trading at $82 a barrel.